Hello and welcome to the Mutual Fund Show. I'm Neeraj Shah. Over the next 20 minutes, we'll talk about key aspects surrounding the mutual fund industry in the current landscape. And, and yes, there is no bigger discussion than what's happening on the debt fund side. So we will include a slice of that as well. Though, as you've seen over the weekends, or rather since Friday morning, there's been quite a bit of coverage that we've done. But it'll be always good to get in people after they've had time to distill their thoughts, think at it from a not just a 50,000 feet view, but maybe a 5,000 feet view as well. So we'll try and do that today on that aspect. And much as the debate around actives and passives has continued for long, we thought we'll give a bit of a twist and try and figure out what is it on the active side that can necessarily, or even now, generate strong returns vis-a-vis the passives, because the large caps arguably are not able to do that. So we'll try and do that with two experts today. Anthony Heredia, he's MD and CEO of Mahindra Manulife Mutual Fund, and Yogesh Kalwani, he's Head of Investment and Family Office at InCred Wealth. Gentlemen, both of you, thank you so much for joining in. Much appreciate you taking the time out. The debt category first, whoever. Okay, Anthony, let me start with you. What's your sense? Does this, well, for a lot of people, it levels the playing field, and I think Yogesh's view out there would be very crucial. But my question to you is, do you believe that if you had this category or debt fund category in a meaningful way for you, you would have been at a disadvantage, or are there products enough within the arsenal of the mutual fund industry to still get in customers on the debt side?
So I'm an optimist by nature, but let me just state that obviously the changes last Friday are a dampener, and I say this in the context of the fact that in spite of the many efforts of the industry, I think the retail investor really hasn't been buying debt funds in any event till this point, and I think this particular change creates an even higher level of difficulty in terms of getting the category to be more retail. So that's part one. Part two, if you step back, and I think you made an interesting point, it's been almost a week. The reality is that 80% of the category of fixed income and liquid within the industry really is not changed, right? Because anybody who invests with typical durations of a year and below doesn't do it with a tax arbitrage point of view. So I would say we're discussing and debating the 20%.
Of
And I
course.
think the difficulty I think the industry would have is the loss of growth potential. I don't think it's the loss of current business, because like I said, there is only a limited amount of retail money that exists in debt funds. I believe there are solutions. For example, I'm sure the industry will work on trying to make the hybrid categories more relevant. Uh, and we will need some policymaker action within that as well, because there are funds like conservative hybrid that do have the ability to go up to 25%, but obviously the new norms require 35. So you need some adjustment. Uh, and I think fundamentally we would have to look at how do we, from an investing philosophy standpoint, rethink how we look at dynamic bond funds, because I think that genuinely becomes the main fund in focus, right? Because if there is equalization of tax, then you have to earn your fee. And the category that allows you to earn your fee and deliver an alpha over a static debt portfolio that the investor would have bought themselves is dynamic bond. And I think that's an area that I would believe the industry will start to focus on as well.
Yogesh, thanks, and good to have you. The first time that we are talking. What's your sense? Do you concur with Anthony, part one? And in your case, because I reckon that the bucket that you cater to would be the HNI and the ultra HNI community. And while the sub 1 year things don't change, but let's talk about the change, or about the change that's happened. What is in it for those people? Would you, as their well-wisher, look at debt fund options, or are there other options out there for your clients?
Sure. Hi. So definitely that's a big change. It definitely changes the way investments were considered by HNIs, UHNIs, and even not so much, okay, maybe retail investors, but investors who were worried about the tax angle, the post-tax returns were the key decision-making factor, definitely. Having said that, if you look at the scenario, I mean, we are coming out of a low interest rate environment. The interest rates have moved up. The reason I bring that to point in is because HNIs and UHNIs or investors were considering bonds as well as high yield opportunities, alternate funds, as an avenue to make an additional return. Now, the mutual funds return started looking up when the quality AAA space started doing better returns after the policy rate hikes, etc. So that hike was good enough to attract back AUMs to the mutual fund industries on the debt side, etc. Now, with this change, where you have tax neutrality, in the sense, no difference whether you buy a bond or you buy a fund, the preference, I would say, for HNI investors and UHNI will be a mix of both. Earlier, that 100 rupees would have gone to a mutual fund. Now they'll take some liberty and maybe allocate, buy a single bond preferential basis. That would also be considered. So there will be some, I would say, reallocation from a debt mutual fund category into direct bond or an FD basis where the rates are attractive. Having said that, debt mutual funds remains a core. Why it remains a core is because it offers liquidity. Corporate bond markets are still not very liquid in India. So even if people allocate to that, it would not be a very sizable portion, because when they need liquidity, that's probably a bond which may not be sellable or will take some time to sell off. So debt mutual funds will remain core because of the liquidity reasons, professional management, and a diversified pool, which means a lesser credit risk. So it would be a balancing act between how much overall portfolio return they're chasing, but definitely there will be allocations to bonds and FDs which will come up, with debt mutual funds still being a core because of the liquidity and stability which it offers.
Okay. Now, maybe I should actually ask this question to Anthony, but I'm still asking a follow-up to you, Yogesh, before I ask the same question to Anthony. And maybe logically, people who choose debt do that for a reason, and they don't arbitrarily invest between equity and debt. But there's a lot of people who believe that for the small investor who maybe used to, the corpus was not very high, and therefore portfolio allocation, right, at the very onset was not necessarily the prime thing to do. The prime thing is to grow the AUM systematically, but grow the AUM maybe for that bucket. So you may not be catering to that bucket, but I'm just wondering, does that bucket invest increasingly more on the equity side, because the debt side taxation, indexation benefits, and therefore the possibility of double-digit returns is now mota-moti out of the window?
So yes, I would agree that the preference of a category which is, say, affluent and mass affluent, or I would say retail and mass affluent investors, is towards equity-oriented products. When I say equity-oriented products, it includes a balanced fund, a balanced advantage fund, or even a pure play equity funds. Why so? Because of past performance. So if you look at the way mutual funds are sold in India, unfortunately, fortunately, people not, while asset allocation is the right thing to do, people do tend to look at what's been a best performing fund. So if you have a 15% CAGR on an equity fund over a 3-year or a 5-year period, and if you pick up even after this market decline, a equity return of a mid cap, flexi cap, or any other category, you do find returns of upwards of 15% on a very long period of times. So definitely the promise of making that outsized return, which is 15% plus, if you hold it for 3-5 year perspective, is a reason why people get attracted to mutual fund. Because if they have to make that 8%, 7%, and 9% return, they have their FD solution or a postal product solution or any other fixed income solution. So the category which is retail and mass affluent prefers a mutual fund product, largely due to equity and equity oriented products like balanced and balanced advantage funds.
Sure. Okay. Anthony, similar question to you. And part 2 of that question also is that within the existing categories, I know you mentioned that you're hopeful that conservative hybrids at some point of time, the regulator may move on and instead of 25%, make it 35%, so on and so forth. But within the current set of rules that exist for the debt categories, what is there a first amongst equals when it comes to the debt side for somebody who's looking to invest in debt funds even now? and is not mass affluent, therefore not necessarily have the advice, depends on shows like these in order to try and understand what is available for her or him?
So, Neeraj, let me answer the second part first because that's
Please.
relatively simpler. I think, for most investors, and I think that's what we've been recommending, is effectively the shorter end in any case, because we have a very flat yield curve in any event, right? So, for investors who are retail mass affluent, they're able to get a return without too much of a volatility of an interest rate view with a short-term bond fund and below. So, I don't think much changes on that front for them. Because like I said, the journey of convincing the retail investor to go longer term in bond, in any case, is a journey that's a long way from being fulfilled. And I just genuinely believe that while there's been a lot of media chatter and industry chatter that hybrids are an automatic solution, I don't necessarily agree, because I don't see how products that have 50% equity or above become a solution to provide alternatives to stable income. I mean, it just doesn't add up. So I think we will need some innovation in terms of, working with the 35% as a construct of a bit of equity and a bit of arbitrage. So you kind of get the tax benefit, and then the remainder goes into long-term bond. I think that is clearly, to me, the product of the future that provides a sensible, logical solution. And I think over the next 3 or 6 months, I'm sure you'll find. I mean, let me give a very basic example, although that's a flippant product idea at this point. But you look at target maturity funds that have been the rage for the last 6 months, right? What stops somebody from launching a target maturity fund with 35% arbitrage and the rest of the 65% still doing what it did? It's still a very attractive proposition, frankly, from a 3 and 5 year perspective, because it has indexation and all of that. So I think when you step away from the noise, there's enough and more that one can keep doing. To the first part of your question on the retail side that you spoke to Yogesh about as well, let me just address a macro concept first, right? Retail and mass affluent investors or Indian households in general are anyways underinvested in equity, and traditionally have invested in fixed income, government savings,
Sure.
and so on and so forth. So I think logically the path of getting them to increase allocations to equity will anyways continue. And I think the journey for retail penetration will continue to be equity led. I don't see anything, not just over this year or next year. I think this decade will be about, the SIP story, investors understanding that equity is a long-term wealth creation objective. And I don't think they will worry too much about should they be looking at fixed income, because I would believe that if you had to just kind of broad brush the population, they're anyways over invested in fixed income. We can argue whether it's the right fixed income and so on and so forth.
Yeah.
But I think for them to come to mutual funds, I think equity is a much natural port of call relative to hybrid or fixed income.
Okay, point well taken. Yogesh, just one quick follow-up before I move on to the next topic, and that is, should there be innovative products like the one that Anthony spoke about? Would there be of interest to clients, or are people a lot more specific about what they want? I mean, should a 35% arb and the remaining debt kind of a product, which gets indexation benefits, be attractive enough?
So it's been there. I mean, it's okay. The arbitrage of the tax advantage which a debt fund was offering is now not available. Hence, maybe this category gains some traction. But will it be a substantial category like maybe a balanced fund or pure play equity fund or a debt fund? Unlikely, in my view. But definitely there will be some allocations which will be a blended hybrid or a multi-asset product which can come, and it's been traditionally there but never got too much traction or attention purely because the debt side was advantageous on the tax and the equity side also had advantage. Now with the debt tax advantage not being there, this category still has a better tax advantage than a debt fund. So that's the only reason why it will get traction. I don't think there's a investment case per se, but the investment case will be driven from a tax benefit which comes through the hybrid sector. That's the view which I hold right now, but we'll have to see if there is a track record or there is some solutions built on a hybrid platform, which is tax advantages and also meets expectations of investors.
Who knows? FY24 could turn out to be a year of multiple new innovative things, which we'll get a chance viewers to talk about on the show as well. The second thing, viewers, that I think we asked on social media today, and there were some positive responses, is to try and figure out active versus passive from an angle of what on the active side has the right to win as things stand on or passive for the next foreseeable future. Because the argument of large cap active funds being beaten hands down by passive by and large, as per the Spiva scorecard and multiple other things, is now a proven thing. So there's nothing new that I discuss on that. But are there active categories necessarily which you don't even have to think about moving on to the passive side, but stick to active for the foreseeable future? Now, Anthony, you recommended that conversation. Let me start with you. What's your view here?
So I'll come to the large cap at the end, because I
you will? Okay.
I do have a different viewpoint, but I think logically the small cap and the mid cap space are spaces in which one would feel very confident that there's alpha to be added over benchmark. And I would say any fund that's a derivative of that, so therefore flexi cap and multi cap, then become automatic categories where you would believe active would make sense. That's point number one. Point number two is, and this is a controversial and debatable, I will admit, but what I find perplexing is the constant comparison between the regular plans of active funds and passive, because I would believe that somebody who's doing passive is a do-it-yourself investor. And I would believe that do-it-yourself investor is smart enough, or she is smart enough, to buy the direct plan of the active fund. And you will then find that the differential in TRs are very minimal, right? So I would say that, and that builds on to my point on large cap as well, which is that when you actually look at the direct plans, it's still not as stark a difference as the Spiva report makes it to be. But larger than that, Neeraj, and this is an admission, and I can say that even internally we've been talking about it. I don't want to take it as a given, or let's say I'm not accepting defeat, that we do not have a right to outperform the benchmark on large cap. The point is, what do we therefore do in terms of portfolio construct or the way we approach it to give us a higher chance of beating the benchmark? And obviously, it will come with a higher risk of not beating it as well, which is where I'm alluding to is, what is the degree of activeness that you've historically seen with large cap funds? Is there a need to relook at that? Because at the end of the day, if the TERs are such a substantial portion of the differential, if you have information symmetry like you have with large caps, then you have to figure out ways and means to think out of the box to try and outperform. And I think at least we've been talking about the fact that, do we need to think about running our large cap fund differently from the way we do the other funds, particularly with regard to the extent of activeness that we will display? And I'm being very clear, it obviously comes with the downside risk as well, right? Because if you're making an attempt to be more active, higher tracking error, in an order to outperform, you obviously increase the risk of underperforming. But I think that's the way to go, because if you're accepting defeat and saying, I will underperform, but so what? Please give me money. I think we're living in a fool's paradise.
So, Yogesh, would you, as somebody who observes these funds, maybe let's say that you even recommend these funds, I'll make you wear that hat. One, would you be comfortable with a fund house of your choice doing that kind of heightened activity? Two, would it be possible for a fund house of a very high AUM to be able to carry out that activity very, very successfully?
So we haven't seen anyone being successful so far in that attempt of generating alpha by not moving away dramatically from the benchmark. So the current trend of large caps, I would not say a large part of the portfolio is hugged to the benchmark, but at least in the top 5-7 heavyweights, you do see an allocation which is there. And the allocation, then I would say the active bets which they take on the portfolio are on the rest of the portfolio. But the key alpha, I would say, can be generated if someone attempts moving away from index heavyweights. And that's where, again, so you know what, again, a critical point being, what's the benchmark? Now, is it Nifty 50 or is it Nifty 100? Because from a large cap point of view, it should be Nifty 100. And it depends on what's the fund benchmark which you're tracking. So we haven't seen success so far because, like Anthony said, the risk is you also underperform significantly. So if in your attempt to increase active bets, you will end up making wrong decisions, and hence it's like if someone does it right, it's like take it all. I mean, and all the AUMs will really move there, but people would not take that risk. It's very too high a risk from a fund manager's perspective.
No, but let's say if Anthony is taking that risk, Yogesh, would you be comfortable recommending a fund to your clients if you had to recommend funds to your clients, which is doing such heightened activity?
Absolutely.
You would be.
Absolutely. I'll tell you why. Because when you're talking about outperformance of a benchmark, now when everyone looks at Nifty 50, the minute you change it to Nifty 100 large cap, you have talking about 100 stocks. Now you can't have a 100 stock mutual fund portfolio. The reason why you're going to a professional manager, you're trying to help him trying to get better stock portfolio or a well allocated right companies in the portfolio, right stocks in the portfolio. You do that in a mid cap and a small cap, wherein you tell the fund manager, this index is like 250 constituents, etc. Whereas you construct a portfolio which is 60, 70 stock and help me generate a better return than a small cap index or a mid cap index. And it happens there because the index is too broad and the fund manager portfolio is relatively smaller, 60, 80 stocks. And you generate that alpha because of the stock picking, business selections, etc., which it plays out. It can be done in large cap. Very few people have tried it. Not too many have been successful. The problem is it's cyclical as a return. So not very consistency. Consistency is a challenge in a large cap to generate that alpha. Whereas in a small and mid, what we have seen is the consistency of generating an alpha compared to a benchmark has been phenomenal. So I was looking at some 10-year data on a small cap fund return. It's like 25% plus CAGR. Now, you can't beat that. 25% CAGR on a 10-year basis on a small cap is phenomenal return. And hence, you've beaten the benchmark by 7-8 points each year. So out there, it's more consistent, long-term. Large cap, it's cyclical and not consistent. That's a challenge which one has to address. Okay. Having said that, one more point which I would like to add on the same passive and large cap question is the other way to look at it is a better risk-adjusted return. So, aggressive balance category. There are funds which are able to deliver you a better return than a Nifty by taking lesser risk, by having 35% component into fixed income, up to 35%. And thereby the better risk-adjusted return. So you have a lower volatility standard deviation and a return which is equivalent to a passive fund or an index. And hence, it's a better product. So rather than playing a passive, the other way to look at it is I go reduce my risk, standard deviation, and still have an opportunity to get a same return like what a Nifty delivers. And that's where I feel that's another way to look at it from an active allocation perspective, and not really consider a pure passive fund.
Okay. So last questions, and I'll come to the main topic and end this topic with you, Yogesh, about what on the broader end of the spectrum or what within the active side. But Anthony, before that, when do we expect some changes like this coming in from the industry or from you? Because Yogesh clearly stated not too many people have succeeded, or we've seen, even I don't remember having studied mutual funds for so long, seeing too many funds which are trying to do quite a bit on the active side in order to beat the benchmark on the large cap side, that is.
So so Neeraj, let me point out one contradiction that goes unnoticed, right? Which is look at the outperformance of focused funds, which is a separate category. And that is a category that actually, if you look at data, is outperformed just in line with small caps. And everybody is convinced that small caps, active is the way to go. Interestingly, if you actually look at average exposure capitalization wise within focused over the last 3 years, 70% is large cap. So my point is that if you could outperform the benchmark, with 70% large cap? Why can't you do it with 100%? What's the difference? And the missing ingredient in our view is focus and conviction, which requires therefore higher activeness. So I think the industry is demonstrating, right? Because just remember, there is a flexi cap and a multi cap that typically runs 50-60% large cap.
Yes.
So how is it that all of these categories manage to outperform the benchmark, but the large cap doesn't? Is there therefore room to introspect? And I think when you introspect, I'm not discussing moving into a momentum or an extremely active or a high risk. I'm just saying clearly there are other spaces within the categorization where we seem to be doing pretty well on large caps. Why can't we translate that onto the main category itself? And that's besides the fact that there are funds, let me confess, that do outperform the large cap benchmark as it is. But I'm just saying, if we've done it so far, that's not the point. The point is, what are you going to do going forward, given these information symmetry, given the lack of options, given the 5-7 heavyweight benchmarks? To my mind, the answer has got to be that you have to do something different. But that doesn't mean you have to do something silly just for the sake of being different. I think there are possibilities, and activeness, for me, at least at this juncture, is definitely something we have to take a look at.
No, let's see if it yields. I mean, I never debated that there aren't funds which wouldn't have beaten the large cap benchmark, Anthony. For sure, there are and would be. It's just that the data seems to suggest that consistent outperformance over the last few years has been lacking. Though I take on board your point, maybe look at it from an angle of do-it-yourself investor investing in a direct scheme versus a passive product, and then try and compare, maybe. But point well taken, and I wish you all the best, Anthony, if you indeed go down that path in a very, very quickly and try and give returns, because it's great for investors. But I'll come back and end the show with the final point with you, Yogesh, and that is on the subject that we started the topic with, which is, if large caps are not the conversation point here, let me rephrase my question. What within the active side is a no-brainer in terms of beating the passive side? We have Anthony's views here. What are yours?
Small and mid goes without a doubt. It's India has a huge universe of investable stocks, and a lot of it is under researched. So if you go beyond the first top 100 companies, it's an under researched space. You can't really go and buy. Investors can't go and buy stocks there directly. You can always buy top 50 stocks directly, create your own portfolio, track it. And it's too much information, data available. Company disclosures are great, etc. So that's a do-it-yourself segment. The mid-cap, small cap, a lot of opportunities, different themes playing out, trends playing out. That's a segment which is definitely needs professional investor help. And that's where mutual funds comes to play, and we have seen over, like I was mentioning earlier, 10 odd years, 25% CAGR on a small cap 2-3 funds. You should look up that data. That's phenomenal. So you don't need to really work too hard.
What are those funds, Yogesh?
So looking at the data, it's
these are not recommendations from you, which is just naming the name
I'm
of the performance.
Naming the thing. So okay, the data changes every month. So, but because it's point-to-point return, so you say it's Feb data. It's Nippon and SBI. So both Nippon, SBI, I believe Kotak also. It's not maybe 10, maybe 5+ years, but all these 3 funds, small cap, over a very long dated period, have delivered 23 to 25, 26% CAGR for such a long period of time. So by just staying put in the right manager in a small and mid cap space, you can generate a phenomenal return and alpha. So that's where passive really won't be able to do justice, because in a passive fund in a small and mid cap space, you have 250 stocks. Yeah. So if you have 100 moving up, 150 moving down, you'll never be able to make a great return. Whereas actives will do justice in that space.
And viewers, please remember, past performance is never a good indicator of what the future might hold. So don't go thinking that if the fund has done so well for 10 years, it will necessarily do that. It may well do, but there is no necessary thing like that. So please consult your financial advisor, or whether that fund or the funds that Yogesh spoke about are necessarily the right fit for your portfolio or not. But it's the first time that we've spoken to both our guests today on the Mutual Fund Show. Lovely talking to you. Thank you for your insights and joining us on the show, and look forward to talking to you more often.
Yeah.
Thank you.
Thank you, Neeraj. Have a good evening.
The pleasure was ours. Viewers, thanks for tuning into this edition of the Mutual Fund Show.